Imagine this. The average American household has less than $5,000 saved for retirement, and nearly 80% of investors underperform the market. Shocking, right? These numbers tell a clear story. Most people are doing something wrong when it comes to managing their money. I was one of them. But everything changed when I picked up one book. This book didn't just change how I invest, it changed how I view wealth, success, and financial freedom. It revealed strategies that most investors ignore, but these are the strategies that actually lead to long-term wealth. I went from struggling to make ends meet to having a clear plan for financial success. In this video, I'll take you through 6 life-changing strategies I learned from this book. You'll discover how to identify undervalued stocks, why patience is your greatest asset, and how to invest like the smartest minds in the market. You'll learn what I wish I knew years ago, so you don't have to make the same mistakes I did. Ready to change your financial life? Let's dive in. Chapter 1. The Hidden Truths of Value Investing. What most don't tell you. When I first started investing, I thought I had to be quick and active in the market. Everyone around me was talking about making fast profits. But then I read a book that flipped everything I knew about investing upside down. It revealed hidden truths about value investing that most people overlook. One of the biggest lessons was that the best investments often take years, not days, to pay off. It's a mindset shift from chasing immediate gains to building wealth slowly. The book taught me that patience is your best friend. A study by Dalbar found that the average investor earns less than the market by about 4% annually due to emotional decision-making. The real key is learning to ignore market noise. The book mentioned how the stock market is like a noisy carnival, filled with distractions. Successful investors don't let the noise pull them away from the fundamentals. What stood out was the principle of intrinsic value. This idea, popularized by Benjamin Graham, suggests that a stock's true worth is not what it's trading for today but what it will be worth in the future. It was eye-opening to realize that the stock market often misprices companies, and value investors capitalize on these opportunities. One line from the book stuck with me. The market is a voting machine in the short run, but a weighing machine in the long run. The book also highlighted that many so-called experts actually rely on trends and momentum, not solid financial principles. Warren Buffett, one of the most successful value investors, once said, "Price is what you pay, value is what you get." This simple truth changed my perspective on how to approach the stock market. Instead of following the crowd, I learned to seek out undervalued companies that had solid growth potential but were being ignored by others. Chapter 2. The Power of Patience. Why slow and steady wins the wealth race. In the fast-paced world of investing, patience is often overlooked. Most investors are in a hurry to see their money grow, but this rush can actually hurt your returns. The book introduced me to the idea that wealth grows gradually. Successful investing isn't about jumping from one stock to another but holding on to your picks for the long term. It reminded me of the tortoise and hare story. Slow and steady wins the race. The data backs this up. According to a study by Fidelity, long-term investors, holding stocks for 10 years or more, have a much higher chance of success than those who frequently buy and sell. In fact, holding on to stocks through market volatility can give you returns that beat the average investor. Patience allows you to ride out the inevitable ups and downs of the market. The book used Amazon's growth as an example. In its early days, the company wasn't the tech giant it is today. Investors who stuck with it through the tough years saw massive returns. That's the power of patience. You buy when others are fearful, and you hold until the market catches up with the company's true value. I also learned the importance of compounding. Warren Buffett often talks about how he doesn't need to make huge returns every year. Instead, he focuses on compounding his wealth over time. The book explains that even a modest annual return, when reinvested, can snowball into a fortune over decades. But there's more to it. The book didn't just talk about financial patience, it stressed emotional patience too. Investors who can keep their cool during market crashes are more likely to come out on top. It's easy to panic when stocks drop, but the key is to remember that the market recovers in time. Patience isn't just about waiting for profits, but also about waiting for the right moments to act. Chapter 3. The Silent Killer of Investments. How to avoid the shiny object syndrome. If there's one thing that can ruin an investor's success, it's chasing after the next hot stock. This behavior, which the book calls shiny object syndrome, can be disastrous for your portfolio. It's easy to get distracted by the latest trends or the company everyone is talking about, but that's often when you end up overpaying for something that's already peaked. The book uses the dot-com bubble as an example of what happens when investors get caught up in hype. During the late 1990s, tech stocks were flying high, and everyone wanted in. But many of these companies were overvalued and didn't have solid business models. When the bubble burst, countless investors lost their money. The lesson here is simple. Just because everyone is talking about something doesn't mean it's a good investment. Another valuable tip the book provided was to focus on what's real, not what's flashy. Instead of getting lost in trends, value investors concentrate on understanding a company's fundamentals. What's their earnings history? Do they have a competitive advantage? These are the real factors that predict long-term success. The book's quote, "Don't chase the shiny object, build your own treasure chest," really resonated with me. One of the most surprising statistics I came across was how many investors jump into overvalued stocks without doing the homework. A study by Morningstar found that 55% of investors buy stocks based on trends, not financial analysis. This is exactly what value investing avoids. By focusing on real data and solid business fundamentals, you avoid the temptation to follow the crowd. The book also pointed out that investing in what you know is a great way to avoid getting distracted. When you understand an industry or business well, you're better equipped to assess its true value. Buffett himself has famously avoided technology stocks for years, not because he doesn't believe in them, but because he doesn't fully understand the sector's long-term dynamics. If you're enjoying these tips, don't forget to hit the subscribe button and turn on notifications. There's a lot more valuable content coming your way that you won't want to miss. Chapter 4. Unlocking the secrets of the balance sheet. Turning numbers into fortune. If there's one thing that changed how I looked at stocks, it was learning how to read a balance sheet. The book emphasized that understanding the numbers behind a company is more important than any buzzword or headline. By diving into the balance sheet, you can discover how financially healthy a company is and make smarter decisions. It's like having a treasure map that leads you straight to hidden opportunities. The book explained that a strong balance sheet shows a company's ability to weather tough times. It focuses on the key metrics: assets, liabilities, and equity. A healthy company will have more assets than liabilities, giving it room to grow and survive market crashes. The book gave the example of a company with too much debt. It's a ticking time bomb. Companies that are over-leveraged are often one bad quarter away from a disaster. One of the most eye-opening facts I learned was how undervalued companies often have strong balance sheets but get overlooked by the market. This is where value investing shines. In fact, a 2020 study by McKinsey found that companies with strong financials outperform the broader market by an average of 3% annually. The book urged readers to look for companies with low debt, good cash flow, and solid profit margins. These are the signs of long-term stability. Warren Buffett once said, "The most important quality for an investor is temperament, not intellect." This perfectly aligns with what I learned from the book. It's not just about reading numbers, it's about having the patience to look beyond the surface and understand the deeper financial health of a company. The book helped me realize that value investing is about finding stocks that others have ignored, based on their financial strength. Another key takeaway was the importance of comparing a company's balance sheet over time. If you only look at a snapshot, you may miss trends in a company's financial health. The book recommended looking at least 5 years of financial data. This approach gives you a clearer picture of how a company has evolved and whether it can sustain its growth. Chapter 5. Investing like a contrarian. Why going against the herd pays off. One of the most powerful lessons from the book was learning to be a contrarian. This is where most investors fail, they follow the herd. But true value investors know that often the best opportunities come when everyone else is afraid. The book taught me that when the market is in panic mode, it's time to pay attention. It gave the example of the 2008 financial crisis, when stock prices were plummeting. While most investors were selling off their portfolios in fear, some of the most successful investors were quietly scooping up undervalued stocks. Warren Buffett, for example, famously said, "Be fearful when others are greedy and greedy when others are fearful." This was one of the most powerful pieces of advice I took from the book. The data backs up this contrarian approach. A study by J.P. Morgan found that, historically, the market has delivered its highest returns in the months following a major downturn. In fact, in the 2 years following the 2008 crash, the S&P 500 returned an average of 17% annually. The book explained that the market often overreacts to negative news, creating opportunities for those brave enough to buy. It's easy to buy into the fear when the media is filled with doom and gloom, but that's exactly when you should be doing the opposite. The book emphasized that successful contrarians don't just buy any cheap stock. They buy quality stocks that are temporarily out of favor. This requires deep research and a strong belief that the company's fundamentals will eventually shine through. The book also shared the story of how George Soros made his fortune by betting against the British pound in 1992. He saw that the British government's financial position wasn't sustainable, and while everyone else was betting for the pound, Soros went against the grain. He made over $1 billion from that move, proving that contrarian investing, when done right, can yield massive rewards. Chapter 6. The $1,000,000 question. What makes a stock undervalued? When I first started learning about value investing, I was obsessed with one question. How do I know if a stock is truly undervalued? The book helped me find the answer. It explained that the key to identifying an undervalued stock is looking at a company's intrinsic value versus its market price. If the market price is lower than what the company is actually worth, that's where the opportunity lies. One strategy the book introduced was the price-to-earnings (P/E) ratio. This is one of the most common ways to evaluate whether a stock is undervalued. The book explained that if a stock's P/E ratio is lower than its competitors or its historical average, it might be a sign the stock is undervalued. But, of course, it's important to look at this metric in the context of the company's industry and growth prospects. The book also introduced me to the idea of the margin of safety. This is a key concept in value investing that says you should only buy a stock if it's trading below its intrinsic value by a significant margin. This cushion protects you if the market doesn't immediately recognize the stock's value. Benjamin Graham, the father of value investing, believed this was one of the most important principles for minimizing risk. Another unique concept the book discussed was the importance of assessing the company's competitive advantage, or what's often called an economic moat. Companies with a strong moat, like brand recognition or cost advantages, are more likely to maintain their value in the long run. The book highlighted how companies like Coca-Cola and Microsoft have maintained their dominance because of their economic moats, even in changing markets. I also learned that assessing a company's future prospects is just as important as evaluating its current financials. The book stressed that understanding the industry dynamics and the company's position in the market can help determine if it's truly undervalued. For example, if a company is in a growing industry but is temporarily out of favor, its stock might be undervalued, even if its numbers don't immediately scream bargain. One final tip the book gave was to avoid getting caught up in the excitement of a cheap stock without looking at the bigger picture. A stock might be cheap because the company is in trouble or because the market isn't optimistic about its future. That's why understanding the underlying business is so crucial. The book showed me that the real value of a stock is determined by the company's fundamentals, not by short-term market fluctuations. These strategies have completely changed the way I think about investing. Now, instead of chasing quick profits, I focus on value, patience, and smart decisions. I hope you're ready to apply these lessons in your own financial journey. Don't forget to subscribe for more insights and strategies to build your wealth the right way. Stay tuned for more tips coming soon.